We've got Kaushik Das, Director and Chief Economist India, Deutsche Bank Research, now joining in. Thank you so much for taking time out. I just want to get in a take as to how you're looking at the overall outlook in terms of the economic pain that we're seeing, because that clearly hasn't abated. What do you believe is the need of the hour right now to help revive the economy?
Hi. So we are seeing a bit of sequential improvement, from the April lows, and we will soon have the core infrastructure production number for the month of August, and probably you'll see a contraction of -5 to -7% compared to -9.5% that we saw in July. And that should be the same kind of number for industrial production as well for the month of August, and coming down to probably -3 to -5% in September. So over the period of time, you'll see a sequential improvement, and we are projecting July-September GDP to contract about -9% compared to -24% that we got in April-June. So the worst seems to be over. Only thing is that the sequential improvement would be slow, and it'll take probably mid-2021 before we can reach the pre-COVID-19 levels, or even after that. So we would expect the government to announce some fiscal stimulus measures now that the economy has started opening up. We are already in unlock 4 phase. And therefore, the second half of the fiscal year starting from October, we would expect the government to announce fiscal stimulus worth 0.5% of GDP. Not much space is there, but 0.5% of GDP for the time being should be okay, along with RBI keeping rates on the lower side for a long time.
Kaushik, while the government, the centre really has, deferred the loan moratorium case to the 5th of October, there have been hints of this holistic package. What exactly is it that you think they're working with and could potentially be announced?
So, they have already announced the one-time restructuring of loans, so market will focus more on that. The sufficient time has been given, 2-year time period for which loans can be restructured, and within which you can have moratorium as well. So the focus has shifted to that one-time restructuring of loans. Now we need to see how many companies are coming and actually asking for that restructuring from the banks. That will get evident in a few months' time, and that will kind of indicate what kind of stress we have in the system. So that is not clear as yet. But RBI would be also focusing on probably giving this time the GDP growth forecast for the year. They haven't given till now, and the inflation forecast for the different quarters going forward. The last forecast that we got from RBI was in February 2020, so it's been more than, close to 6 months, so we would expect some forecast from RBI. So that would be interesting to see what kind of growth contraction RBI is working with. We have a growth forecast of -8% for FY21, and inflation, averaging about 5.7% for the year. So RBI's forecast will give a sense to the market what kind of risk band RBI and the MPC will be working with, which can inform the market going forward. What will also be interesting to know from RBI, whether it comes in the when the next policy is announced or outside the policies, what is RBI's thought process in buying government bonds? Because there will be a lot of supply of government bonds which will be hitting the market. And today, sometime the second half borrowing program would be announced. And our expectation is that the second half borrowing would be about 4.3 trillion INR, in line with the 12 trillion INR that has been announced so far, the remaining amount. And then later, at some point of time, there could be a risk of increasing that borrowing amount, but not at this stage. So the question is, who will be buying these bonds, and whether RBI will show intent in doing more open market purchases, and that will help then support the bond yields at 6%. So a lot of things expected from RBI, so markets eagerly waiting for the announcement of the 3 external MPC members, as well as the date of the next policy meeting.
All right, so still awaiting, of course, what comes out of that. In terms of really room to move right now, Kaushik, as well, what are the numbers suggesting, could be the implications? Because already, we've perhaps perceived that given the borrowing numbers, the government's unlikely to increase its borrowing any further. It may leave rooms for some hikes at the end of the fiscal, and of course, we might see a spike in yield. But what's your sense in terms of really any room to maneuver here?
So at this stage, we are not expecting outright any announcement of increase in borrowing. So government has borrowed 7.7 trillion INR out of the 12 trillion in April to September. So the remaining amount should be 4.3 trillion. Now, any amount, if it comes above 5 trillion, market will take it negatively. But we are expecting the balance amount 4.3 trillion to be announced for the time being. And then maybe, December, January, when the government has a better sense of how much shortfall they'll finally have on the revenue side, or what is the outlook on fiscal deficit when they're going to present the next budget on 1st February, there is a risk that market is pricing in that probably, January to March, there could be a risk of increasing that market borrowing if the government is not able to get enough revenues and fiscal deficit is going up. So that risk is there, but not at this stage in my view. So we'll see how it goes. We are working with a fiscal deficit estimate of 8% of GDP. In that 8% of GDP, that includes a bit of stimulus that the government has already given and probably will give another 0.5% probably, but that's it. So you'll have 8% of GDP fiscal deficit from the center and 5% from the states. That's total 13% of GDP for India as a whole. And that itself will push the debt GDP to close to 87% in FY21 from 72% last year. So there is actually not too much fiscal space that the government has. And therefore, the market borrowing also, they are a bit conservative of increasing it further because yields will have a natural tendency to move up if the borrowing numbers are high. And the second thing is that RBI is not in a position to cut rates in the short term because inflation has moved up. And the September number could be higher than the previous 2 months of 6.7 because onion, tomato, potato prices have gone up. So you probably could get a 7% handle on inflation in September. So if RBI is not cutting interest rates and the supply of bonds are hitting the market, then the only expectation is that RBI will be buying a lot of bonds to help yields stabilize at around that 6% mark, which I think RBI is working with for the time being.
Sure. Kaushik, great to have you on the show today and so candidly speak about the state of the economy and, of course, your opinion on the same. Good to speak with you today.